It's time for another Lucia Capital Group Weekly video. As financial advisors, we do a lot of work with clients who are planning to pass their assets to their heirs once they're gone. And usually it's their kids, but not always. But in either event, it's important to know what the benefits and consequences are of inheriting tax-deferred retirement accounts. It's that tax-deferred characteristic that can trip some people up, either because they don't know the rules or because they didn't think that those rules applied to their situation. Whenever you inherit an IRA or a 401k or other tax-deferred retirement account, you will ultimately be required to take a minimum amount of money out and pay taxes on it. This is true regardless of the age at which you inherit that asset. The question is, when do you have to start taking those required minimum distributions, and when do they end? Well, here are some things you need to know. First, if you're a surviving spouse, you have some flexibility when you inherit an IRA. Typically, you can either transfer the assets to your own IRA, at which point you then become the new owner, or you can simply treat it as an inherited IRA. But keep in mind that if you make yourself the new owner, if you're under age 59 and a half and you need to access the money, you'll have to pay a 10% early withdrawal penalty for doing so. On the other hand, if you leave it in the deceased spouse's name and you treat it as an inherited IRA, there are no required minimum distributions for you until that spouse would have reached their own required minimum distribution age, either age 73 or 75, depending on their birth year. With this option, since you are not the owner of the inherited IRA, there are no penalties for distributions before you reach age 59 and a half. Okay, that's for spouses. For non-spouses, the rules are different and a bit more complicated. When you inherit an IRA as a non-spouse, you'll have a required minimum distribution on that inherited IRA, even if you are nowhere near your required minimum distribution age. And this includes inherited Roth IRAs. Also, as a non-spouse, you're not allowed to transfer or roll over funds from an inherited IRA directly into your own IRA. When you distribute funds for any reason, it's like receiving a check that's payable to you, and it's taxable. You also can't do a 60-day rollover with the inherited IRA funds, nor can you convert them to a Roth. Yes, the rules are tight. But there is no 10% early withdrawal penalty on any inherited IRA. You'll be taxed on any funds you take out, unless it's a qualified Roth distribution, but you won't have a penalty. Now here's where the complexity really kicks in. If the IRA owner died prior to 2020, and they had not yet reached required minimum distribution age, then you have two options as the non-spouse beneficiary. First, you can take an RMD every year starting the year after the IRA owner died, based on your own life expectancy, and stretch it out over that period of years until it's gone. The second option is to completely distribute the IRA, in other words, take all the money out, by the end of the 5th year after the owner's death. Normally, if the inheritor doesn't need the money, this option is necessary only when the beneficiary misses the first RMD. So if you miss an RMD in the first few years, then the entire IRA must be distributed within that 5-year window. But if the person who died was of required minimum distribution age, then there's no 5-year option. You must take an RMD out every single year, or you'll be assessed a penalty for missing it. And that penalty can be as much as 25% of the shortfall. Thankfully, though, this has recently been reduced from 50%. Okay, but what if the owner died in 2020 or later? Well, most non-spouse beneficiaries no longer have the lifetime stretch option. In most cases, the entire IRA will need to be distributed by the end of the 10th year after the owner's death. Unless the deceased owner already had an RMD, there's no minimum amount you need to take out in years 1 through 9. But if the deceased owner was at required minimum distribution age, then the beneficiary will have an RMD in years 1 through 9. In either case, 100% of the money must be distributed by the end of the 10th year. Now, this 10-year clock doesn't begin for a beneficiary who is a minor until they reach the age of majority, as defined by the IRS. And these new no-stretch rules don't apply to beneficiaries who are less than 10 years younger than the owner, or to beneficiaries who have chronic illness, or who are disabled, again, as defined by the IRS. And even if you don't have to take any money out of the inherited IRA for some period of time, you may still want to, just so you won't have a large distribution that is all taxable in that final year. Hey, We told you it was complicated. So why is this important? Because making mistakes or violating the rules could create a lot more taxes and penalties for you. You need someone advising you who is familiar with the rules, the benefits, and the consequences of all these various scenarios that I just laid out. At Lucia Capital Group, we deal with things like this every single day. If you're in a situation where you're inheriting taxable assets or you plan on giving taxable assets to anyone after you're gone, it's a really good idea to talk it over with one of our advisors so we can help you to avoid paying any unnecessary taxes or penalties. How can we help you the most? Just give us a call.